Okay, hi everybody. Today's Friday, 21 April 2023, and this is the last session of our half-day LPFMI introductory webinar series. And right now we're welcoming Guillaume Vuillemey.
That's not bad.
And Guillaume is an associate professor of finance at the HEC in Paris. He's an associate researcher at the CEPR in London and an associate researcher with the French banking regulator ACPR, with the ACPR's chair on systemic risk. His research fields are banking, financial stability, corporate social responsibility, and economic history. He has published numerous research articles, notably in the Journal of Finance, the Review of Financial Studies, and the Journal of Financial Economics. He won several prizes, including the prize for the best young researcher in economics awarded by the Bank of France, or Banque de France, and he holds a PhD in economics from Sciences Po Paris, and he is the author of Le temps de la démondialisation in 2022. And Guillaume is also a comeback. I tried to find out which year it actually was, but you had presented your first paper, not your first paper, but the first historical or the other historical paper on the 1972 CCP failure in Paris to us. Celine Cheng was organizing that webinar at the time. And so now we're glad to welcome you back a second time, Guillaume. We're looking forward to your presentation, and I'll hand over the floor to you.
Thanks a lot for having me. It's a great pleasure. Can you see my screen?
Yes.
Excellent. So let me maybe just drop this. Very good. So I'm going to present this paper called Mitigating Fire Sales with a Central Clearing Counterparty. And just the overall motivation is, of course, I need to be maybe clear ex ante. There are many rationales for why we have CCPs, many that are probably much more important and of first order than mitigating fire sales. And very often we think about CCPs as institution, mitigating credit risk, providing insurance, where you commit to post collateral. So there are many rationales for why we have CCPs, but I claim that these existing theories of CCPs, somehow they cannot really well explain one feature of CCPs, which is the fact that when CCPs, when members default, CCPs run auctions to liquidate the defaulting members' positions, and these auctions include incentive mechanisms which incentivize surviving members to post bids at very high prices. And what I'm going to argue is that this mechanism can be understood as a way for CCPs to mitigate fire sales. So I'm going to make this argument theoretically, but the paper is not theoretical, and I'm going to try to study an historical event in which I think for the first time this kind of feature appeared in the context of CCPs. Okay. So just maybe after this, as an introduction, so we know that fire sales are extremely costly in a wide variety of contexts. So they induce, of course, inefficient liquidations, predatory trading, ex-ante liquidity hoarding. And so very often we think that the only or the main agent that can do something about fire sales is either the regulator or the central bank. For example, central banks can support asset prices, or they can do something else. And the reason why we think that public agents have to deal with fire sales is because they typically are coordination failures. In a sense, in a fire sale, very often, if we all sell at low prices, we would be better off if none of us was selling and none of us was pushing prices down. But if I expect all of you to sell, then I want to sell myself, okay? And so we think that somehow we need the regulator as a way to fix this problem and to say, well, at some point, I'm going to support prices to avoid fire sales. And what I'm going to argue is that we can think of CCPs as one mechanism, one institution that can actually eliminate some fire sales without the regulator, or really as a private contracting mechanism. And so, for example, in the event I'm going to study, there will be really no role for regulators in this context. Okay. So I'm going to cover briefly the theory and then the empirics. So in terms of the theory, so just to clarify, as I said, very often most models of fire sale, they feature some coordination failure. So we sell, or part of us sell, because we expect other people to sell, and if all things like that, then all of us are selling, prices are low, we eventually want to sell further, and so on. Okay. Of course, a very famous model of this is Diamond and Dybvig. Okay, and here the coordination problem arises from the first come first served basis. I want to take my deposits out of the bank before anyone else. I want to be first in the queue, in a sense. A very interesting recent paper by John Kwong shows that even in collateralized markets, where there is no first come first served basis, where people have collateral, and so there is no issue with first come first served, there may still be fire sales, because if I expect people to sell, then I want to sell myself. Okay, and Kwong has a very nice interpretation of this. He says, well, there are several policies that can support prices. There may be public policies that may support prices, but we can think of CCPs as an institution that will somehow play this role. Okay, and I think one way we can interpret the mechanism in the paper by John Kwong is in the sense that CCPs, because when you join the CCP, you commit to pay high prices in auctions that are run on the member defaults, then CCPs are really a mechanism to pre-commit to support prices and pre-commit not to participate too much in the fire sale in case a large member default and many positions have to be sold. Okay, and there is a related paper which I think is very important by Huang and Zhu, which essentially models CCP auctions with incentive mechanisms. And again, the findings there is that CCP auctions may be used to support prices. Okay, so I think this argument is in general relatively quite attractive theoretically. It works, or it is expected to work mostly in two contexts. First of all, mostly for idiosyncratic shocks, because of course, it means that, okay, we pre-commit to pay high prices in events of stress. That's what surviving members do. They pre-commit to bid high prices in event of stress. And so it will only work if the shocks are sufficiently idiosyncratic. If all members default at once, then it will not be useful to prevent fire sales. And second, it will work if free riding can be eliminated. Okay, in a sense, you know, if only some members pay high prices to support prices in the event of a default, everyone could think, well, you know, I'm very happy if all of you pay high prices to support the market, but I'm going to stay out of the mechanism. Okay, and somehow I will benefit from all of you bidding high at the CCP in default, but not paying high myself. Okay, and so for this mechanism to work, it has to be that somehow it ties all members or sufficiently many members to participate in those auctions. Okay. So with this as a theoretical background, let me tell you a little bit about the historical setup I'm considering. Okay. The historical setup I'm considering is an historical event in the wool market of Roubaix-Tourcoing, which is in the north of France, which was, of course, today Roubaix-Tourcoing is not very famous and very well known, but it used to be actually really a major center of the Industrial Revolution. People used to call it the French Manchester. So Manchester is probably not so important today in the UK as it used to be in the 19th century. It's really the same for Roubaix-Tourcoing. Okay, and in particular, a very large part of the wool trade in France was coming through this city. Okay, and the key reason why we had a CCP there is the following. So generally speaking, wool trade gives rise to price risk for dealers. So just to set up the stage, a lot of the wool was coming from Australia. Okay, very little wool was produced in Europe. Most of it was coming from Australia and a few other countries, but mostly Australia. Okay, and then when wool was collected, dealers would buy very large inventories, store them, and eventually sell them throughout the entire year. Okay, and so of course, because there were dealers holding large inventories, those inventories were exposed to price risk, that the price, of course, could change between the time they bought this inventory and the time they sold. Okay, and so there had been a futures market with the CCP created in 1888 to hedge this risk. So most of the people trading here are not at all banks or anything like that. They are really people with an interest in the wool market, essentially wool dealers or wool merchants, things like that. Okay, and this CCP was a very standard CCP by that time. It was essentially really, doing what modern CCPs do, meaning becoming direct counterparties to all members in the market. So whenever two of us were trading, the CCP will interpose in the middle and guarantees the trade to all of us, to both of us. To do that, it would collect collateral. And the rule was, well, if a member defaults on margin calls, then the position is immediately liquidated. Okay, there was no specific mechanism to prevent fire sales. There was no adequate default waterfall or no auctions with incentive mechanisms, nothing like that. Okay, so that's just about the general setup. Now comes 1900. So there was a massive crisis coming from a large change in prices. Essentially, early on, prices had been booming really quite a lot. People expecting the supply of wool to become very low. And when people realized that the supply was not that low, prices dropped really a lot. So in about a few months, wool prices dropped by 46%. Okay, and by August of that year, in Roubaix-Tourcoing, 18 trading houses had suspended payments. Okay, and of course, the key concern is that this would result into massive liquidations that would then further lead to a drop in prices that would itself lead to further margin calls for the surviving dealers that would then eventually fail and essentially have this kind of liquidity spiral whereby liquidations lead to lower prices, lead to margin calls that themselves lead to other liquidations. And so I found in the archive, many documents really making very clear that people were really having in mind this kind of dynamics already at the time. Okay, that was really well understood. Okay, and so to study those events, I have a number of archive sources. The main one, just to mention quickly, is a daily newspaper that was published in the exchange, and I could find the complete collection of this newspaper where I have, all the prices, the quantities traded, and a lot of news on whatever happens in this market. Okay, and then I match this with other data sets, but the main one is really this newspaper that has survived. Okay, so what I'm studying first is, first of all, the decisions that were taken to mitigate the crisis. Okay, I'm going to discuss that, and then I'm going to show you. So I'm going to proceed first by telling you some kind of narrative example, narrative evidence consistent with the theory, and then show you some tests that these decisions were successful. Okay, the first thing which is quite remarkable is the following. First of all, we know that in context of where fire sales are likely, or in those liquidity spirals, we have a number of recent models. I mean, when I say recent, it's over the past 15 years, essentially, models like people like Lasse Pedersen and so on, showing that fire sales can be associated with predatory short selling. Predatory short selling would mean, people who are themselves not very constrained in terms of paying margins, for example, and that would short sell to push prices further down, lead people to liquidate their positions, and eventually buy back at fire sale prices, expecting that prices will go up in the future. Okay, and so the first thing is that the CCP at the time really took the decision, used the tool it had in order to try to mitigate this predatory short selling. So it increased margins in several steps, and in particular, imposed special margins very high for short positions, meaning essentially it discouraged entirely almost taking short positions. And on top of that, it even ended up imposing a penalty if you take positions that you settle without physical delivery. The idea was that, okay, people can trade, they can take positions, but we want them to physically deliver in the sense that kind of showing that they have really an interest in the wool market and they are not just there to speculate on prices. Okay, that was the first step. And then when all this default occurs in a couple of days, what happens is very, very interesting. So, of course, I give more details in the paper, but the general story is as follows. So, if the CCP had acted according to its rule book, it should just have liquidated the position in the market. And of course, in normal times, that may not be so problematic because the market may be deep. But of course, when there are already many people liquidating, that could lead to further drop in prices. Okay. And so what the CCP did, what the members did, was to say, okay, let's not do that. Let's actually organize a sale among the surviving members to avoid disorganized fire sales, if you want. Okay. And so what happened ultimately is that most of the large traders came around the table, agreed to a settlement at above market prices, so above what would have prevailed in case of a disorderly liquidations. And that's, in a sense, very much like what happens really in an auction. It's not really an auction in a strict sense, but really people agreed that agreeing on a high price where they would liquidate, I mean, where they would sell between themselves all the positions was better than just liquidating in a disorderly way. Okay. And what is kind of interesting in this context is that those decisions were really not in the rule book of the CCP, because there was absolutely nothing in the rule book of the CCP that was saying you should meet and discuss this kind of solutions. And so because of that, actually, very early on, some people really criticized this solution very, very strongly by saying, oh, the CCP, there's something which is not mandated by the rule book. What is very interesting is that very soon, after a few days, the critics turned often, almost always actually, very positive, in the sense that people understood that the decision of the CCP, of the members as well, was beneficial to the market as a whole. That somehow it was kind of a public good that was provided because of this settlement at above market prices. Okay. So you can think, well, how was this coordination possible? I think there are two main reasons for that. The first reason is that there is a large literature, mostly, I mean, the most famous is the Harvard historian David Landis, that has actually a paper on family ties, specifically in the textile industry in this city of Roubaix-Tourcoing. Okay, and actually many of the dealers, and I have a lot of that in the paper, they are families which were linked with marriage and cousinship and things like that. And somehow it was kind of, it made the cost of probably coming up with a mutually beneficial solution easier than would have been the case in a market with completely anonymous traders. Okay. Of course, another benefit of this family ties in this context was that probably deviating was more costly, especially if family values are strong. You know, you don't want to be the one free riding on all the others, probably. Okay. The second thing, remember I told you in the theory part that a major risk, of course, could be that there are side trades. There are people who free ride, for example, people who say, okay, I'm very happy if, you know, if those guys negotiate, but on my own, I want to be on the safe side. So I want to liquidate or I want to do something different. Okay. And actually, the CCP seemed to have been very aware about that because they prevented side trades. In a sense, they said they issued a new regulation, or they did two things actually. First, they suspended the publication of prices during the time of the negotiation, so that people who are not sitting with the CCP, they have very little knowledge about what prices are. Okay, so even if they try to do things, They don't really have a benchmark to tell them, well, what you are doing is at a good price or at a bad price. That's the first thing. And second, the CCP refused to register all trades with members that would do side trades. So all members had to explicitly commit to register absolutely all of their trades with the CCP and nothing else. And that somehow killed all of the incentives to trade outside the market, because this outside market would then be very illiquid, with probably the worst market participants, and that could not really work. Okay. So the CCP was really successful at achieving coordination because of these two features. Okay. If now we try to see, well, was there any price dislocation? Was there any fire sale in any sense? Okay. We don't really seem to see any, right? So here I compare the price in Roubaix-Tourcoing with the one in Antwerp, which is the most comparable futures market at the time on the wool market. So if anything, we see more deviations between Roubaix and Antwerp before the event than after the event. And actually, these deviations before the event are quite well explained by the narrative, because there is evidence that there was a syndicate of dealers that was trying to contain the drop of prices in the run-up phase to the crisis by buying more and more, hoping to support prices. And actually that could explain why, for some periods of time, the prices in Roubaix were higher than the prices in Antwerp. Okay, but after the crisis, we don't really see much. Okay. In the paper, I do many tests to really, I have prices at several maturities. I do many tests to try to see whether we have price dislocation after the event or before the event, by comparing the distribution of prices, running tests like Kolmogorov-Smirnov test. And I really see that, if anything, the price deviate more between Antwerp and Roubaix rather than after. Okay. Another way to test for this fire sales would be to say, well, but the comment that I often got is to say, well, but it's not very clear that you should see anything here, because perhaps people just arbitrage between Roubaix and Antwerp, and so prices drop, but they also drop in Roubaix, so we do not really see any difference between those two lines. And that's of course a very fair comment. To address this comment, I say, well, but the good thing is that I have futures at many maturities. And of course, people can arbitrage between Roubaix and Tourcoing, between Roubaix and Antwerp, but it takes a bit of time. Okay, at the time you have to sail to those places to arbitrage and so on. And so, if it's very likely that you can arbitrage at longer maturities, but it's less likely that you can perfectly arbitrage at short maturities. And so the idea is to say, well, we can exploit this in a difference regression. I'm going to say that maturities are more likely to be treated if they are short maturities, okay? Because those are maturities that are likely to be sold, but unlikely to be arbitraged across markets, while longer maturities are more likely to be arbitraged, even if they are sold, okay? So what I want to see is if the price deviation or the absolute price deviation to this measure that I have here is greater specifically for the short maturities and specifically after the event. And if this is the case, we should expect the beta coefficient here to be positive. The price gap, whatever the direction, widens between Antwerp and Roubaix right after the event. Okay. If you run the regression, if anything, we find exactly the opposite. We find a negative and significant coefficient. And if you actually compare the magnitude, we really just see that the magnitude of the drop after the deal compensate exactly almost for the difference in prices that existed before the crisis. Okay, so what we see here is not any evidence of fire sale. It's really just that there was, if anything, actually more mispricing before, and then it gets corrected afterwards because those guys that were, trying to contain the drop in prices are no longer there. Okay. And then the last kind of test I'm doing is to say, well, we don't seem to see any fire sale after the CCPs agreed to liquidate everything. Do we see any effect on real economic activity? Okay, and there I go to the archives of the customs and I collected data on trade flows at the city level. Okay, so what I have is actually trade flows on 14 types of textile, including wool, of course, in 20 cities, and luckily, Roubaix-Tourcoing is in those 24 cities. Okay, focusing on trade flows is actually quite nice in this context because they are known to be very volatile. Okay, for example, if you take any recession in general, trade flows drop much more than GDP. Okay, so if there is really any evidence of a drop, specifically in the wool industry, we should really see them in the wool industry. Okay, and of course we don't have any GDP at the time, but there is no reason why this elasticity should have really changed over time. Okay? And so here I'm going to do a triple and diff, where I'm going to say, okay, I'm going to compare with 3 levels of variation. First of all, before and after the crisis. Second, between wool in Roubaix and wool in other cities in France. And then within Roubaix, between wool and other kinds of textile not affected by the price drop. Okay. And so I'm going to do all of that and do variations along these lines with slightly various regressions. And the general idea is that whether I look at the share of import or the log volume, I don't really find anything. Okay, I really don't find that the crisis had significant impact on trade flows, specifically in Roubaix and specifically in wool. Okay, regardless of the measures I take, here I have only, I think, the regressions on import, but I have the same one on export in the paper. And again, I don't really find anything. So I think it's kind of convincing evidence that the crisis did not trigger a long-lasting drop in the wool industry in Roubaix-Tourcoing. Okay. Now let me use the last, I don't know, couple of minutes. I don't know exactly how much I have to discuss implications for CCP design. So the first thing I would like to mention is to say, well, you know, those mechanisms, of course, what CCPs do today is a little different. But basically, now all CCPs have mechanisms, or most CCPs have mechanisms where they will try to think in default about whether they should liquidate defaulted positions or whether they should run auctions. Okay, and running auctions means, well, trying to avoid outright liquidation, convene members, and see whether we can find better solutions, and incentivizing members to bid high in a variety of ways, either with fine, most often with juniorization of defaulted contributions, and so on. Okay. Very often today, those auctions and those juniorization mechanisms, those incentive mechanisms, they tend to be understood only as a way to protect CCPs, which is, I think, a very good rationale. Actually, I think that was the point by Robert earlier on. I think it's a very valid point. But I think that another way to see this device is to say, well, perhaps it's also a way, on top of the protection of the CCP, to protect the market as a whole by avoiding fire sales that would otherwise be more disruptive. Okay. And so if we think about along these lines, then there are a couple of implications we can draw. For example, we can think, well, perhaps auctions should be run when there is a risk that the market is disrupted, but even if there is absolutely no risk that the CCP is disrupted. Okay. And if this is the case, you may think, well, maybe there are cases where CCPs will not be, will remain very far away from distress. They may not want to do auctions, but participants would like to do auctions actually to avoid disruptions in the market. And so that may be a good argument in favor of having members perhaps involved in the corporate governance of CCPs, which of course typically they participate to, and I think that's of course a great thing. Okay. I think another implication is that in general, it's a good thing if incentive mechanisms, so this, for example, juniorization mechanisms and so on, bind whenever large default occur and not just when the default fund of the CCP is at risk. Okay, that could be another implication. And of course, this argument applies to only one kind of CCPs, which are CCPs induced by the default of a member. If you have fire sales triggered by any other reason in the market, then there is no real much that the CCP can do beyond perhaps collecting margins ex ante that may limit fire sales exposed. Okay. Let me perhaps conclude here. So I think one way to understand CCP above and on top of all the other important justifications we have in the literature is to see them as a private mechanism to eliminate at least some fire sales, and that this can shed light on an important feature of their default waterfall. Okay? Thank you very much.
Excellent, Guillaume. Thank you very much for an excellent presentation, which I have enjoyed very much. Let's now turn it to our two discussants, and we're going to start with Robert first. So I'm going to briefly introduce you, Robert. Besides the fact that you probably don't need much of an introduction, at least around us here. Robert is a lawyer by background. He's currently a senior policy advisor at the Chicago Fed for around 20 plus years. In previous lives, he has been an in-house counsel of predecessor companies of what is today CME or CLS. And as I said, he's I haven't mentioned that here yet. So, and he's a de facto co-founder of our little project here since 2018 or so, though we met in 2015. And papers recommended to read by Robert from our point of view, that is now the young scholars are probably the most quoted for is co-written by the late Bob Cox. A CCP is a CCP is a CCP. And then the one that I think many young scholars enjoyed a lot or most is a paper called Time Critical Liquidity. And I think in his current research interest, Robert is taking often an historical interest in events, and recently in the epistemology of regulation, of financial market regulation. And any mistakes in that are mine, and maybe you can add or change anything in that, Robert. But with that, I hand it over to you.
Thank you, Kiko. You set me up nicely for the disclaimer I'll have to offer. Thank you to you and to the other organizers for inviting me to participate in this discussion, which I find very interesting. It's an honor to be invited to consider the very interesting and thought-provoking issues that Guillaume has raised. I do need to make a disclaimer. As most of you know, my comments today are solely my own and not necessarily those of the Federal Reserve Bank of Chicago or the Federal Reserve System. Some points I think I will start with. First, I'd like to recognize Guillaume's work in this area, which has evolved over some time as an interesting contribution to the literature. As Kiko has noted, I do have an interest in understanding the historical evolution of central counterparty clearing, which I find to be a very interesting, multifaceted financial mechanism. It has not always been the case that CCPs were a focal point of academic consideration. In fact, the literature before the great financial crisis of 2008-09 was, in fact, rather limited. And that stands by interesting comparison to the deep literature that has existed for a long, long time concerning the operations of the payment system. This may reflect little more than the arcane nature of central clearing, which is not so well known generally, as other financial infrastructures such as exchange trading systems. But as noted in an important survey of the literature on central clearing by Guillaume and his co-author Albert Mengveld, and a similar survey by Ron Berenson, there has been a recent surge in academic interest in market structure, and in particular, the role of central clearing in market structure. This in particular follows the imposition of the G20 mandate for central clearing of certain swaps that followed the crisis. So we have this upswing in interest, and not just an interest in gross terms, but an interest from multiple perspectives, which is of keen interest to me, including law, economics, technology, and much more than that, to which I say hooray. And I consider Guillaume's paper an important addition to this expanding literature. Turning to the points Guillaume has made, he notes in the paper, and as is reflected or was reflected in his comments, the analysis set forth in the paper is primarily related to a literature on asset fire sales. Without resumeing the various points Guillaume has just made, it contains a theoretical component relating to market institutions that may result, or market circumstances, I should say, that may result in fire sales, which the literature Guillaume has relied upon attributes to coordination failures. And Guillaume makes a very interesting, or provides a very interesting discussion of how private contracting through mechanisms such as central counterparty clearinghouses can be effective at mitigating fire sales. It is, I think, worth further consideration how we should think about these private contracting alternatives to public regulation. And that sort of ties in with Kiko's remark about my interest in what I'm calling the epistemology of financial regulation. I won't say very much about that, except to say that for me, that's a very grandiose way of just saying, what do financial regulators know, and how do they know it? On what grounds do they think they know what they need to know to impose effective, sound financial regulation? But enough of that. I'm just happy to see that Guillaume's paper provides a springboard for further thinking about in that direction. I'm not going to repeat some of the underlying dynamics there. So the particularly provocative thing for me about this paper is that it views CCPs through the lens of mechanisms to avoid fire sales, using in particular the circumstances of the global wool crisis of 1900. So I think Guillaume has done a splendid job of describing how the facts of that circumstance, the facts of that distress relate to the theoretical considerations he's brought to our attention. The important part for me is the discussion of conclusions concerning the design and operation and regulation of contemporary CCPs. In particular, Guillaume speaks about CCPs as involving a pre-commitment to pay high prices in the event of participant default. But here I find myself unsure what Guillaume means by high prices. There is a bit of a discussion of this issue in the paper, but I am reminded of the discussion in the Huang and Zhu paper, which speaks about this in terms of the internal resources that are available to the CCP. I hope I can make this point more clear as I go on. More generally, I think there's some ambiguity about what the term contract liquidation means in the context we are discussing today. For me, the CCP faced with a participant default is faced immediately with the problem of reestablishing a matched book. And that does not imply the liquidation as in the termination of the positions of the defaulter. In fact, it is the case that the CCP inherits those positions, continues to perform on them for a short period of time, and attempts to find a replacement to assume those obligations from the CCP. So the perspective that I'm arguing for here is that we should be very careful about the use of the term liquidation, which for me implies a transfer to a new solvent counterparty who can perform the obligations that the defaulter can no longer perform, thereby protecting the interests of the surviving non-defaulters who are able to continue without disruption as a result of the default, which affects only the CCP directly, at least in the first instance. I think it's important to distinguish that kind of liquidation from the termination of open contracts, which necessarily will affect the rights of surviving non-defaulting participants in the market with likely inevitable market disruption. I think the ambiguity surrounding the use of this terminology has burdened the discussion, at least made it more difficult to understand some of the arguments that are being made by Guillaume and others who have addressed this issue. So I think associated with that point, I would say what I find especially missing from Guillaume's discussion is a consideration of alternatives for the CCP to auction, which include the liquidation mechanism that I just discussed, liquidation in the open market, and forced allocation, by which the defaulters' positions would be transferred in some fashion to the surviving non-defaulting members of the clearinghouse. There are many policy and efficiency concerns associated with forced allocation, and it seems that that mechanism is slowly disappearing from the toolkit that CCPs have available to them. But I think it would be very interesting for Guillaume to tell us what he thinks the implications of forced allocation without the use of a pricing mechanism, either the open market price or an auction price, are, and how that might fit into or shed some light on the analysis that he is offering us. More generally, I have a concern that we may lose sight of what I call the internal objectives of the clearinghouse to maintain contract continuity, notwithstanding the fault of one or more market participants. That for me is the cornerstone internal private objective of the clearinghouse, and the tools that a CCP may use to accomplish that purpose may come into conflict with broader social public objectives, including in the case of default auctions, the possibility that a defaulter's resources will be completely absorbed in the process of liquidating the defaulter's positions, leaving other creditors of the defaulter, that is, creditors of the defaulter that stand outside of the clearinghouse, at a disadvantage, as was argued by the examiner in the Lehman Brothers bankruptcy case following the crisis. There are other examples one can think of. A CCP may choose, if it's unable to reestablish a matched book following the exercise of its various tools for doing so, may choose to terminate the positions of the defaulter. And in this case, I am intending to refer to an action that would terminate the rights of the surviving non-defaulting members of the clearinghouse. That may have financial stability implications that are undesirable. And this has become an important point of contention in the discussion about CCP resolution alternatives. For today, for now, I won't pretend to take a position one way or the other, only to illustrate that there are many points of contact between the private objectives of central clearing and their members and broader public concerns. Let me just finish by saying once again how much I appreciate Guillaume's discussion of the wool crisis of 1900. I don't dare try to pronounce the name of the location of the market and the caisse that is discussed in Guillaume's paper. I have nothing to add to his discussion of the facts in that case, and I welcome it as an addition to the literature. Regarding the theoretical structure, I suppose I'm interested to see what conclusions can be drawn from starting with the perspective that CCPs are designed or should be designed or might be designed to mitigate fire sales. I'm interested to see where that leads us. Ultimately, I think it brings me to this concern about the potential conflict between the private internal objectives of the clearinghouse and broader social objectives. So while I'm not entirely persuaded, I'm sure I have a lot more to learn from a closer reading of Guillaume's paper, and I look forward to having the opportunity to discuss with him my comments and those of others in the days to come. So I will end there.
Perfect. Thank you, Robert. Before Guillaume has a chance to respond to your comment, we're gonna first turn to our second discussant, to Alexander. And he's just turning on the camera. Alex is the head of default management trading of the default management trading team at Eurex Clearing in Frankfurt, Europe. Prior to joining the CCP, he held several trading positions both in the buy and the sell side, specializing in the fixed income and FX markets. He's a practitioner, so that's always a good thing to have on these academic conversations, to have someone like you on this, Alex. But he also has a PhD from the University of Vienna in the fields of software engineering, IT. And all mistakes otherwise are mine. Alex, if you want to add something to this, feel free, and the floor is yours.
Thank you very much for the kind introduction, Kiko. And yes, as you mentioned, I head the default management trading team for Eurex Clearing. So Eurex Clearing is a CCP, and it will be my team that actually does any rebalancing in case of a member default. And similar to Robert, I have a disclaimer. So yeah, these are my views and not necessarily Eurex Clearing views. I'm happy to, if you need a statement, I'm happy to provide one, but yeah, please give me the chance to review it. And yeah, what I say today is purely my views, and yeah, hasn't been pre-agreed with my employer. So, but yeah, let me jump into the paper, and also, yeah, thank you. It's great to be a part of this. It's my first time here today. Hopefully not the last. It's been really interesting so far, and I hope I can add a little bit to the discussion from a practitioner's point of view. So, first of all, I love the story. So, what's not to like, right? It's about markets, price dislocations, and it was an exciting read, especially for someone with my background, but I'm sure for anyone, right? It's I think pretty thrilling to anyone, and you can imagine the tension that must have been going on with, first of all, the price spike on the way up, and then this pool of traders trying to prop up prices on the way down and failing, and ultimately and defaulting, and creating this problem for the CCP, where the CCP is faced with, okay, well, what do we do now? We have several defaults, and if we go into the open market and liquidate these positions, we're going to push prices lower and end up with a further cascade of defaults. So I was extremely impressed by the CCP, I have to say, by their actions. So Guillaume outlined the measures they took, and they're exactly right. They knew what to do, and I would assume that the board of the CCP were the members and had very strong connection to trading. So that's my speculation, but maybe Guillaume knows something more about that. But it's 100% clear to me that they knew how to contain the situation, and that's for sure not the given, right? So I think trading experience is key. I'm banging my drum a little bit, talking my book, but I do see it as absolutely essential in risk management. And Guillaume highlights the coordination and kind of bringing the members together and hammering out a deal, basically, or agreeing to a deal. And it mentions these high prices, and I mean, Robert also commented on them. I would call them fair prices, because I think there's a distinction between like above market prices and fair prices. Because if you think about it like this, that today's price is here, but if I think that there's like 10 guys who are going to sell during the day, then I'm not going to show a bid here. My bid is going to be down here somewhere, and that's basically the dynamics of a fire sale or this liquidity spiral, right? So with forced selling. So if you can find agreement and get people to pay fair prices and rebalance the CCP that way, which is what I think happened. I think that's for sure the goal of a CCP to find this balance. So I mean, Guillaume highlights this, the coordination. He mentions it several times. I agree with it. I think all the measures they took are extremely impressive. I would probably again highlight the capability of whoever managed to produce this deal, because it's sitting where I am and potentially being in that position of having to get people in one room and agree. I think that's no small feat to do it, and as I said, I'm very impressed. So in terms of implications for the CCP, I mean, there's no silver bullet, right? There's no way to say, okay, this is the recipe. If you always follow it, it's going to work. So I think I'd like to make a distinction between multi-asset CCPs and single asset, because the wool market is just one product, right, and one CCP, and where so why would the member default? Either they default because there are some issues in the wool market, and that's exactly what happened here with the price dislocation, but it could also be some unrelated credit problems. I could be a wool speculator and run into some other liquidity problems, which forces me to then, which would bring me into a default. But that situation is not really a problem for a CCP, right? Because then my market is extremely well behaved. I can very easily liquidate whatever position I would inherit from that member. So there is not each situation is the same, is the point I'm trying to make. And again, I guess in a single asset CCP, is much likelier to end up in this kind of scenario where they are extremely dependent on one asset or one asset class. So I think that's something maybe to think about as well going forward, that when designing or coming with proposals for policy, that there are differences between the CCPs. And but yeah, overall, I enjoyed the read. I mean, I think I hadn't heard about the story, and so it was extremely fun to read, interesting, and again highlighting the coordination and what I would probably add. I mean, it's implied by Guillaume, but I would underline it maybe because of my trading background. But I do think understanding markets is essential in containing a situation like this. So, but yeah, let me end there, and yeah, thank you. Thanks again.
Thank you, Alex. These were great comments. Guillaume, give you an opportunity to respond to them.
Yeah, of course, thanks a lot to both of you. It's really, really helpful. So, I mean, I don't think I will respond to all single comments, but I think there are several general messages. I think one issue which I think came in both Robert's and Alexander's comments is the idea that there is a need for more thinking about what is the optimal policy that the CCP should adopt, what is the optimal mechanism to deal with defaulting members. And on this side, I must say that, for example, what Robert was saying about, forced allocations versus liquidations versus auctions, I mean, I think it's very interesting. I don't think that there are really a lot of theoretical papers on this. I think there is actually very, very little papers. I think it's really a great area to study. So I hope there will be more in the future, but I think that's really something that would be like useful both for policy, but also to guide the kind of empirical work I'm doing. So it's true that, I mean, most of what I do is really documenting historical facts. I don't really want to draw strong policy conclusions out of that. But in general, I agree that there is really a large need for those conclusions and evidence on these topics. I mean, both of you talked about this issue of what I call high prices, and I agree that it's not a very appropriate term. I like the suggestions of Alexander to call it fair prices. I mean, essentially prices that would not include the fire sale discount. Essentially, that's really what I mean, or something along those lines. The auction price, of course, may be a little different from that, but it should not be too different from that. So hopefully that would clarify. I also like the point by Alexander, actually, that CCPs that deal with one single asset class, or even not even asset, but like one contract, are likely to be different from CCPs that trade with multiple assets or that clear multiple assets. So I must say I haven't thought this through completely, how the traders would change in a single asset CCP versus a multiple asset CCP, but I think it's a very important dimension of heterogeneity to consider. So yeah, I think I'm gonna stop here. All comments are very well taken, and I will for sure revise the paper accordingly and try to provide more evidence or be clearer on all the points that were mentioned.
Excellent. With that, we're an intimate group. I'm just going to open up to Lucas or Adam if they have a question and wanted to chime into the conversation. That does not seem...
I'm good. I don't have any questions. Good.
Then we know that's not the case. I thank you, Alex. I thank you, Robert. I thank you, Guillaume, for coming out this morning, this evening, on this Friday to discuss the paper. I just, as a last comment, we talked about this earlier. the 1972 Paris CCP failure has been made to a movie, Le Sucre in French, I think sugar in English, Zucker in German, and with Gerard Depardieu. Guillaume was earlier saying that it's very, very close to the actual events, and I just can say it's a very good movie. And we won't see you, Guillaume, in Frankfurt in June, but hopefully at a next opportunity. I think we will see you, Robert and Alex, either online or in person in Frankfurt. So we will see each other then at the latest again. So thanks again, and have a good Friday, everybody.
Thanks a lot to you, Gerard, and see you soon.
Yes, bye-bye.
And thanks again to Robert and Alexander. It was really nice comments. Very useful. Have a great day.
I'm glad. Nice meeting you. I'll check out your other papers. And
thanks. And the movie.
Yeah.
Exactly. Ciao.
Bye.
Have a good one. Thank you. Bye-bye.